In America, being poor does not simply mean having less money, it means having fewer choices. And when people have fewer choices, life becomes more expensive in ways that are hard to see from the outside. A person with money can solve problems early. They can go to the doctor before an illness becomes serious. They can fix their car before it breaks down completely. They can buy a reliable appliance instead of the cheapest one. They can live closer to work. They can say no to a bad loan, a bad job, or a bad deal. But when someone is living paycheck to paycheck, they often do not get to choose the best option. They choose the cheapest option, the fastest option, the only option available that day. And very often, the cheapest option today becomes the most expensive option tomorrow. That is the hidden interest rate of being poor. Most people understand interest when it comes from money. If someone borrows from a bank, they pay back more than they borrowed. But poverty has its own kind of interest rate. It does not always come from a bank. It does not always arrive as a bill labeled interest. Sometimes it shows up as a late fee. Sometimes it shows up as an overdraft charge. Sometimes it shows up as a payday loan. Sometimes it shows up as a car repair that was delayed because rent was due first. Sometimes it shows up as a toothache that became an emergency because the first dental appointment was too expensive. That is how poverty works. It turns small problems into large ones. It turns inconvenience into crisis. It turns delay into debt. Take Alicia, for example. Alicia is 34 years old and lives outside Atlanta. She works as a certified nursing assistant at a senior care facility. Her job is physically demanding. She helps elderly patients get out of bed, take medication, eat meals, and move safely through the day. Alicia works hard. She's not careless, she's not lazy, but she has not been to the dentist in almost 4 years. Not because she does not know dental care is important. She knows. She reminds her own children to brush their teeth every night. But the last time she called a dental office, the exam, x-rays, and filling were more than she could afford after rent, groceries, gas, and childcare. At first, the pain was small, just a little sensitivity when she drank something cold. Then it became a sharp pain when she chewed. Then it became a headache. Then it started affecting her sleep. A small cavity, if treated early, might have been simple. But when someone cannot afford to fix a small problem, the problem does not wait politely. It grows. Eventually, Alicia may not just need a filling. She may need a root canal, an extraction, antibiotics, or time off work. The original problem was a tooth. But poverty turned it into lost sleep, lost wages, stress, pain, and a much larger bill. That is the interest rate of being poor. People with money pay money to solve problems early. People without money often pay with their health, their time, and their future. This same pattern happens with transportation. In many parts of America, a car is not a luxury, it is survival. It is how people get to work. It is how they take their kids to school. It is how they buy groceries, go to medical appointments, and keep their lives moving. Now imagine Ryan. Ryan is 29 and lives in Phoenix. He drives for delivery apps during the day and sometimes picks up evening shifts at a warehouse. His car is an older Honda with more than 180,000 miles on it. Ryan knows the car is not reliable, but a better car requires a down payment, better credit, and a monthly payment he's not sure he can handle, so he keeps the old car. Then the brakes start making noise. The mechanic says the full repair will cost $850. But Ryan does not have $850, so he asks for the cheapest fix possible. The mechanic replaces only what absolutely has to be replaced. It keeps the car moving for now, but it does not fully solve the problem. A few months later, something else breaks. Then another thing, then another. The cheaper car becomes expensive, not because Ryan made a foolish decision, but because he could not afford the better decision. This is one of the cruelest truths about poverty. Poor people often cannot afford the things that would save them money. They cannot afford the reliable car, so they pay more in repairs. They cannot afford the safer apartment near work, so they pay more in gas and lose more time commuting. They cannot afford preventive health care, so they pay more when the illness becomes serious. They cannot afford quality shoes, quality appliances, quality insurance, or professional help early enough, so they pay more later. There are things that only look cheap because the full price has not arrived yet. Housing works the same way. For many Americans, between 25 and 45, housing is the largest monthly expense. Rent keeps rising. Mortgage rates can be difficult, good neighborhoods are expensive, living close to work often costs more. A person with stable income and good credit may qualify for a better mortgage, a safer apartment, or a neighborhood with better schools and lower transportation costs. A person with unstable income, damaged credit, or no savings often has fewer choices. They may have to rent farther away. They may live in an older apartment with higher utility bills. They may accept a place with a longer commute, fewer grocery options, or less safety. On paper, the rent may look cheaper, but the real cost may include gas, car maintenance, stress, time, and fewer opportunities. This is why poverty is not just about the amount of money in a bank account. It is about distance from opportunity. It is about how many hours a person loses each week just trying to survive. It is about how many problems they are forced to tolerate because solving them would cost too much today. And then there is credit. In America, having money often makes borrowing cheaper. Having less money often makes borrowing more expensive. People with strong credit scores can get lower interest rates. People with weaker credit scores pay more. People with stable jobs can qualify for better loans. People with unstable income may be pushed toward credit cards, payday loans, high-interest auto loans, or buy now, pay later plans. That means the people who most need affordable credit are often offered the most expensive credit. A $500 emergency can become a $1,500 burden. A car loan can quietly take thousands more from a person over time. A credit card used for groceries can become a debt that follows someone for years. And again, from the outside, people may ask, why would they take that loan? But from the inside, the question is different. If the rent is due, the car is broken, the child is sick, and the paycheck is still 5 days away, people are not choosing between good and bad options. They are choosing between bad and worse. That is what people often misunderstand about poverty. Many bad financial decisions are not made because people do not know better. They are made because all the better options have already disappeared. But this is not only a story about the poor, it is also a warning for the American middle class. Consider Megan and Chris. Megan is 37 and works in human resources for a healthcare company in Ohio. Chris is 39 and works as a sales manager for a home improvement company. They have 2 kids, 2 cars, a mortgage, student loans, childcare costs, insurance premiums, and credit card balances they keep meaning to pay off. From the outside, they look comfortable. They have a home, they have jobs, they take their kids to soccer practice, they order takeout on Friday nights, they go on 1 vacation a year. They are not poor, but they are financially fragile. If both paychecks arrive on time, everything works. If nobody gets sick, everything works. If the cars keep running, everything works. If the company does not lay anyone off, everything works. But life does not always work that way. One medical emergency can change the math. One layoff can change the mood of the entire house. One bad investment can erase years of savings. One major car repair can force them to carry more credit card debt. The middle class often lives under the illusion of safety. They are not drowning, but they may be swimming very close to the edge. And for many people, the danger is not one dramatic mistake. It is the slow accumulation of normal decisions. A slightly bigger house, a newer SUV, a vacation paid with a credit card, a wedding financed with debt, a subscription here, a payment plan there, a lifestyle that only works if nothing ever goes wrong. But something always goes wrong eventually. That is why stability matters. Not because everyone needs to become rich, but because falling down is much easier than climbing back up. Poverty is like a deep hole. When people are standing near the edge, they often believe they will not fall. They believe they can manage the payments, handle the risk, and figure things out later. But once they fall in, they discover something painful. Climbing out takes far more energy than staying out would have required. That is why it is dangerous to romanticize risk when there's no foundation underneath. In America, especially among people in their 20s, 30s, and early 40s, there's a lot of pressure to take big risks. Quit your job, start the business, buy the investment property, trade crypto, build passive income, bet on yourself. These ideas are not always wrong, but they are not equally safe for everyone. Risk is different when someone has savings, health insurance, family support, and assets. Risk is different when someone has no emergency fund, high interest debt, and rent due in 2 weeks. For a wealthy person, a failed investment may become a lesson. For someone with no safety net, the same failure can become a disaster. The same fall does not hurt everyone the same way. That is why financial stability should come before financial ambition. Before trying to get rich quickly, people need a foundation strong enough to survive mistakes. That foundation does not look exciting. It looks like an emergency fund. It looks like avoiding high-interest debt. It looks like learning skills that increase income. It looks like taking care of health before problems become emergencies. It looks like living below one's means, even when social media makes that feel boring. It looks like buying time, not just buying things. And this is where the other side of the picture becomes important. Wealth does not just mean having more money. Wealth means having more options. A wealthy person can fix problems early. A wealthy person can wait for the right opportunity. A wealthy person can buy in bulk. A wealthy person can hire professionals. A wealthy person can move to a better neighborhood. A wealthy person can say no to bad terms. A wealthy person can invest when the market is down. A wealthy person can walk away from a desperate deal. Money does not just buy products. Money buys patience. Money buys protection. Money buys access. Money buys the right to choose. And once someone has better choices, those choices often create more money. This is why the rich often become richer. Not always because they work harder. Not always because they are smarter. But because their money gives them access to better opportunities. And their stability protects them from expensive mistakes. Meanwhile, a person without money may be working just as hard or harder, but is forced to keep paying the penalty for not having enough. That penalty is the interest rate of poverty. It is paid through late fees. It is paid through bad credit. It is paid through delayed health care. It is paid through unreliable transportation. It is paid through lost sleep. It is paid through stress. It is paid through missed opportunities. It is paid through the emotional weight of knowing that one unexpected bill can ruin the entire month. The point is not to blame poor people. The point is not to say wealthy people are evil. The point is to understand the math of life. When people have money, problems can be solved early. When people do not have money, problems are delayed. And delayed problems usually become more expensive. That is why the first goal should not always be to look successful. The first goal should be to become harder to break. For someone living paycheck to paycheck, the first step may not be investing or buying a house. It may be saving the first $500. It may be paying off one high-interest credit card. It may be learning a skill that leads to a better job. It may be getting a certification. It may be applying for work with benefits instead of relying only on unstable income. It may be going to the doctor before the pain becomes unbearable. It may be saying no to a purchase that only creates the appearance of success. None of these steps sound glamorous, but they are powerful because every small step towards stability creates one more option, and one more option can change everything. One option can prevent a payday loan. One option can stop a late fee. One option can fix a problem early. One option can protect a job. One option can keep a bad month from becoming a bad year. This is especially important for Americans between 25 and 45, because this is the stage of life where many financial paths are being shaped. Careers are being built, families are being formed, homes are being bought, debt is being accumulated, habits are becoming permanent, and the decisions made during these years can either create freedom later or create pressure that lasts for decades. The goal is not to live in fear. The goal is to live with awareness, to understand that debt is not just a monthly payment. It is future income already promised away. To understand that health is not separate from money. A sick body can destroy a financial plan. To understand that a job is not just a paycheck. It is stability, insurance, experience, and bargaining power. To understand that looking rich and becoming stable are not the same thing. Many people spend years trying to look successful before they have built anything solid underneath. But the real goal is not to impress others. The real goal is to have enough breathing room that life cannot destroy everything with one emergency. Because being poor is expensive. Not because poor people are lazy, not because they are careless, not because they do not work hard. Being poor is expensive because poverty removes choices. And when choices disappear, people are forced to pay more for worse solutions. They pay more for credit. They pay more for transportation. They pay more for housing. They pay more for healthcare. They pay more in time. They pay more in stress. They pay more in lost opportunities. That is the hidden interest rate of being poor. But understanding this is not a reason to give up. It is a reason to move carefully, to build skills, to protect health, to avoid bad debt, to respect stable income, to save before spending to impress, to stop romanticizing risk before building a safety net, to create more choices, one step at a time. Because the moment a person has more choices, the math begins to change. A little savings becomes breathing room. A better skill becomes a better job. A better job becomes less panic. Less panic leads to better decisions. Better decisions create more stability, and stability creates freedom. Poverty charges interest, but stability pays dividends. And for millions of Americans, the first step is not becoming rich overnight. The first step is building a life that is harder to knock down. Because in the end, financial freedom does not begin with luxury. It begins with options. And sometimes, just one better option is the beginning of a completely different life.